Hello, my name is Vicky Hughes and I'm Director of Private Client Services at Brown Butler Chartered Accountants based in Leeds. I'm going to be talking to you about trust today. The aim is to provide a brief introduction and there will be future videos expanding on what is discussed here. Let's start by talking about what will be covered in this session. So we'll be looking at what are trusts, who are the key parties involved. So I'll be talking about the settlor, the trustees, the beneficiaries and protector, and also how are they set up. So let's move on to what are trusts. So a trust is a way of managing assets for people. So it is a situation where you're wanting to give away some assets for the benefit of other people and retain some control over them. It could be that you're wanting to give away money, so cash, investments, such as stocks and shares, or land and buildings. Now, there are different types of trusts that you can choose from, and the detail of the different trusts will be covered in future videos. But the type of the trust that you choose dictates the tax treatment that follows. The rules applying to the trust are stipulated within the trust deed or another written instrument, for example, a will, and these explain the manner in which the property or assets should be held. Now, if you're setting up a lifetime trust, it would be expected that you'd have a trust deed written. But if you are wanting to pass the assets on via a trust after your death, the terms of that would be included within your will, and the actual trust wouldn't come into effect until your death. Tax legislation generally refers to settlements rather than trusts, but either term is often used in practice interchangeably. Technically, the term settlement is broader as it includes dispositions, covenants, agreements, arrangements, or transfers. So now let's talk about the parties who are involved in trusts. The first person is the settlor. Now that would be you if you're wanting to set up a trust for other people and put assets into it. So the settlor is the person who contributes assets to the trust. So for example, cash, shares, or property. The settlor decides how the assets in the trust should be used, and usually those rules are dictated within a trust deed. Now you can have more than one person setting up the same trust. So here you could have joint settlers where, for example, you have a husband and wife that jointly own assets and they're both wanting to put their 50% share of those assets into a trust for their children and grandchildren. Sometimes a settlor can also benefit from the assets in the trust, and in those situations it's known as a settlor interested trust. Special tax rules apply and anti-avoidance rules, and often it means that the settlor continues to be taxed on those assets, subject to special rules. Now, assets added to trusts at different times can cause the settlors of the trust to change over time, and there can also be additional tax consequences, some of which may not be anticipated at the start and may be unfavourable. So this means it's sensible to consider what your plans are in advance of doing anything, and if you're thinking that you might want to add funds into the trust or assets at different times over a number of years, it would be sensible to consider whether you set up one trust and keep adding the funds to it, or whether you set up separate numbers of trusts to take each tranche of assets that you're putting on. So now let's move on to the trustees. These are the people who take legal ownership of the assets that have been contributed into the trust by the settlor. Now, the trustees can either be individuals, and they could be, friends or family members, or they could be professionals, or they could be a professional corporate trustee, or you could have a combination of individuals and corporate trustees. The choice is yours, depending on what factors you want to take into account. Now, in a family situation, members of the family, including the settlor themselves, are often included as the trustees. In more complex situations, a professional trustee might want to be included as well. So, for example, that could be helpful if you think there could be family disputes or difficult decisions to make, or even they could take over the sole trustee role. It's important to choose your trustees carefully, as they do have significant control over the activities and assets of the trust. And also, trustees need to make unanimous decisions. So they all have to agree to the decisions they're making. The trustees have a fiduciary duty to properly manage the trust assets and to treat all the beneficiaries fairly, taking into account the terms and rules as outlined in the trust deed. So it's not a role to undertake lightly, and it's important to understand the role and expectations. Usually you have a minimum of 2 trustees and a maximum of 4, and there need to be at least 2 trustees, that is individual trustees, where you have land and property as the asset of the trust. So the trustees deal with the assets according to the settlor's wishes, and that would be the wishes that are outlined in the trust deed or the will. The trustees manage the trust on a day-to-day basis and pay any tax due to HMRC. They are also deciding how to invest and use the trust assets. If the trustees change, the trust can continue, but there always has to be at least 1 trustee. If there are 2 or more trustees, it would be sensible to nominate one as the principal acting trustee to manage the tax affairs. The other trustees are, however, still accountable and can be charged interest and penalties if taxes are unpaid. Now let's move on to the beneficiaries. So these are the people who can benefit from the trust assets and the income that's generated by them. Usually you'd have more than 1 beneficiary of a trust. So for example, you could have a whole family or defined groups of people. The beneficiaries can be named specifically, so for example, Vicky Hughes, or can be named as a class of beneficiaries, so the children and grandchildren of Vicky Hughes. Now, not all of the beneficiaries that you include have to even be born when you draft the trust document. It can be that you're anticipating that some people might be born during the history of the trust and be included within the class of beneficiaries. The beneficiaries could benefit from the income of the trust only. It might be that they benefit only from the capital, so the assets actually added, or they may benefit from the income and the capital. These are decisions that you'd make when you were having the trust deed drafted. And it is possible for a trust to be discretionary in nature, where the trustees are given the powers to decide who of the beneficiaries benefits at what time and how much they benefit from, and whether it's capital and or income. Charities, as this slide mentions, can also be included as beneficiaries of trusts. Now, a protector is an important person or party to a trust, but you don't always have to have a protector on a trust. Some settlers do like to appoint these within them because it gives them an added layer of protection. So the protector would be a trusted person who would be given the ability to veto certain decisions, and the powers that they had would be granted within the trust deed, for example. It may be that you want them to be involved in the appointment of new trustees, or where decisions are being made to add beneficiaries during the life of the trust. If a protector is included, it's important to understand the implications for the ongoing running of the trust and for the protector themselves, so that they understand the role that they're taking on. Now, we've talked about the 4 main parties to a trust. So now let's make some comments about how to set up a trust if you think that's what you want to do. In theory, a trust could be created without the need for a deed, but it really is best practice to ensure one is carefully drafted to prevent disputes in the future. If you're setting up a trust during your lifetime, it's very much recommended that you do this via a trust deed. And if you're wanting a trust to be created on your death, the terms of that would be included within your will, and the trust would not come into existence during your lifetime. Instead, it would be created as a result of your death. It's important to get a professional to draft the trust deed for you, or indeed draft your will, and this would be something to contact a solicitor about. Often we work with solicitors so that you can have combined tax and legal advice. Drafting a trust deed is a reserved legal activity, so cannot be undertaken by an accountant. If you're wanting to draft a discretionary settlement, then as well as having the actual terms of the settlement or trust drafted in the settlement deed, it would also be sensible for the settlor to provide a letter of wishes. This is a non-binding letter that would be held with the trust deed and would be a means of providing guidance to the trustees. This can be updated whenever the settlor wishes during their lifetime, but it does mean that once the settlor has died and the trust is still in existence, it's a way that the settlor can talk from beyond the grave and give guidance as to how they would wish the trustees to consider making decisions at certain stages of the beneficiaries' lives. As I've said, it can't be binding, but it is a way of helping the trustees to make decisions in the future. Finally, the assets need to be settled on trust, so the legal ownership of the assets has to be transferred to the trustees. If we take property, for example, you'd expect the property records at the land registry to be updated to show that it was now held by different parties so that the legal ownership had changed. I hope you found this brief introduction to trusts useful. If you do have any queries, please do not hesitate to contact us. Please also look out for further videos which will talk more about the different aspects of trusts. Thank you for listening.